All right, we again have a number of people who are participating remotely today, over 20 or so. Let me see. Screen. Okay, sorry about the delay there. I'm having a little bit of technical issues here. So what I want to do today then is go into our second day discussing the money supply process. In the last class, we introduced several really important concepts in discussing this money supply process. So let me just kind of quickly review what some of those are. I think one of the most important is actually being familiar with this thing called the Federal Reserve balance sheet. The Fed's balance sheet has all of its assets on the left-hand side and current liabilities on the right-hand side. And since it's a balance sheet, the sum of all the assets needs to be equal to the sum of all the liabilities. There's several things that are on the asset side of the Fed's balance sheet. I would like you to be familiar with a lot of them, if not all of them. But the two that are most important to work the problems that have to do with understanding how the money supply process works have been highlighted here. That's the Fed's holdings of U.S. Treasury securities, so things like 3-month T-bills plus 10-year Treasury bonds. Those total around more than $4 trillion currently, as well as the volume of discount loans that the Fed has lent to private banks. The two most important liabilities on the Fed's balance sheet was currency in circulation, right? These are a Federal Reserve liability in the sense that it's the Federal Reserve that's responsible for maintaining the integrity or the value of the currency. And then we also have the biggest and most important is the total amount of reserve balances held within the banking system. All of these banks have a checking account or a reserve account with the Federal Reserve. The deposits that they make at the Fed are what we call reserve balances. And there's something on the order of 2-point-something trillion. Adjustments in the Fed's balance sheet, that is changes on the asset side of the balance sheet, are going to create these corresponding changes in Fed liabilities. Usually that means reserve balances or currency in circulation are going to go up and down. Why that is important is because those two items on the liability side of the balance sheet make up this thing called the monetary base. That was the other important concept that may have been new to you in the last class. The monetary base is essentially currency in circulation plus these reserve balances held by banks. When the Fed takes some policy action, like an open market operation, which we went through an example of that in the last class, it increases or decreases reserve balances and therefore changes the monetary base. Make sure you guys know the difference between required and excess reserves. The sum of required and excess reserves tell us the total amount of bank reserves in the system. These ideas are important because changes in the monetary base are going to affect the overall size of the money supply through this thing called the money multiplier, which is something we're going to start talking about today. All right. Now, I think if I'm remembering right, in the last class, we went through this example of how an open market operation by the Federal Reserve changes the balance sheet position of the banking system, the non-bank public, as well as the Fed, and how those changes translate into a change in the monetary base. I want to do another example today regarding discount loans. So I believe this is where I really want to start off from today. I think this is where we left off in the last class. If I didn't, somebody please remind me. I sometimes forget these things. Okay, so let's just go through another easy example about how um, when the Fed issues a discount loan, how that is going to change reserve balances in the banking system and therefore change the monetary base. Again, this will feed into our larger story of the money supply that we'll build on in today's class. And we're just going to do this with another really simple example, okay? Let's suppose that Barclays Bank borrows $1 million from the Fed through the Fed's discount window. So for whatever reason, Barclays is in need of some emergency liquidity. It goes to the Federal Reserve and takes out a $1 million discount loan through the discount window. I want you guys to help illustrate that or the effects of that by using the T accounts here. So we want to think about what happens to the balance sheet of the banking system as well as the Federal Reserve. Excuse me. So again, really quickly, in the banking system, how does their balance sheet appear? The main assets of the banking system are the bank's reserve balances that it holds at the Fed, any securities that it holds, as well as any loans it's made to private investors. The main liabilities of a bank like Barclays are its checkable deposits and the discount loans, which we're going to do in this example, that it's taken from the Fed. And the Fed's two main assets are its securities holdings and its discount loans to banks. Its main liabilities are, of course, the monetary base, reserve balances plus currency in circulation. Okay, so you guys help me out with this one. Barclays takes out $1 million discount loan from the Fed. How does that affect the banking system's balance sheet? Just do this one step at a time. How is that going to affect the banking system or Barclays' assets versus its liabilities? I assure you, you folks will have to do problems like this on your lab and an exam. So being very familiar and comfortable with how to show changes Is that better? Let me, hold on one second. Can you guys hear me now? Okay. Thank you, by the way. Okay, so I think this is right. So the monetary base will increase dollar for dollar when discount loans are issued, but will decrease dollar for dollar when those discount loans mature. Now, let me ask you one kind of follow-up question about this. We've talked now about two different ways in which the monetary base can be altered by the Fed. One is through an open market operation, and the other is through a discount loan. Which method of changing the monetary base do you think gives the Fed has greater control over? So if the Fed would really like to control the size of the monetary base, which of those two instruments do you think gives it greater precision? Open market operations or discount loans? Levi, was that right?
Yeah.
Okay, go ahead.
Discount lending.
Why would you say?
Because with open market operations, maybe there's some like market factors that play. Discount lending, it's like with two large organizations and they say we're going to do this.
Do you have a different answer?
I would say they have more control over open market operations because discount lending is dependent on the banks beating discount loans.
I agree with, what's your name?
Derek.
I agree with Derek. So I think open market operations are going to give the Fed greater control over the monetary base. Why is that? Because the Fed is the one that's initiating open market operations. The Fed will come out today and say, we want to buy $1 million worth of treasuries. One of these primary government securities dealers is compelled to engage with the Fed. So the Fed can increase bank reserves by exactly $1 million by conducting an open market operation. The Fed, however, cannot necessarily compel banks to borrow, right? Other banks can try to obtain liquidity by other means, perhaps by borrowing from other banks, right? And so traditionally, it's thought that open market operations give the Fed much greater precision in adjusting the monetary base. They don't have nearly as much accuracy in using the discount window, and that's because even the Fed can't force banks to take loans from it. Now, with that said, Levi, the Fed can influence the amount of loans because the Fed sets the discount rate. That's the interest rate that district banks charge. Remember that this is the interest rate that discount banks charge private banks for these particular loans. The higher is the discount rate, the less banks are going to want to borrow from the Fed. The lower the discount rate, the more banks will be willing to borrow from the Fed. So they can influence the level of discount lending, but they don't have perfect control over it like they do with open market operations. Okay, before we start talking about the money multiplier and how we kind of build that into the story, I want to show you guys a picture that shows the recent history of the monetary base in this country. And I actually stopped the picture at 2012. But if we extended the graph here, you would know that the picture would get even bigger. Okay, so what is this picture in particular? This is a graph of the total monetary base in the United States starting in 1990. Okay, now the monetary base is given by the height of the graph here, and the difference between the blue and the brown or red, whatever that is, it shows the breakdown between currency, that's the blue section of the graph, and bank reserves, that's the brown or dark red section. Now, what do you guys notice about the composition of the monetary base in the United States before, we had the financial crisis starting in late 2008. The monetary base kind of grew at a nice steady rate, didn't it? Right? It was, by 2008, it was approaching $1 trillion. But more importantly, what constituted the bulk of the monetary base in the U.S.? Currency in circulation, rather than reserve balances at banks. What happened as soon as the financial crisis began? Well, the monetary base exploded, right? It went from under $1 trillion to $2.5 trillion pretty quickly. But more importantly, how did the composition of the monetary base change? Was it an explosion in currency or an explosion in bank reserves? The latter, right? It was a huge increase in bank reserves and really not much of a change in currency in circulation, okay? So the first point here is that the monetary base increased sharply in 2008. That was as a result of something called QE1, or quantitative easing, something you guys may have heard of before. We will talk much more in detail about quantitative easing in the coming weeks. It increased again in early 2012 in late 2010 with QE2. There was another round of quantitative easing a few years later that once again expanded the monetary base. Now, most of these gains, as the graph illustrates, occurred because there was a big increase in bank reserves rather than currency in circulation. Now, we just went through a couple of problems here, and we argued that the main way in which the Fed would increase the monetary base is through an open market operation, right? So in a normal situation, if you guys were to see such a huge increase in bank reserves, then what would that tell you? The Fed must be doing a ton of these open market purchases, which suggests that, hey, the Fed is probably buying a ton of these U.S. Treasury securities. Well, it turns out that during the start of the financial crisis, the Fed's portfolio of U.S. Treasury securities actually fell when the monetary base went up. So all of these T-bills and T-notes that the Fed was holding, their portfolio of those assets actually shrank. So what explains the large increase in in bank reserves then? The Fed had to have been buying something, but it wasn't actually Treasury securities. What were they buying? Mortgage-backed securities. There were other liquidity facilities, like commercial paper. The Fed was buying up a lot of commercial paper that Main Street companies were trying to issue because those markets had frozen up. Commercial paper are short-term loans or bonds issued by big corporations. They also purchased a lot of the agency debt of Fannie Mae and Freddie Mac. And as the Fed accumulated all of those assets on its balance sheet, how did they pay for them? By issuing bank reserves to the counterparties that held all those assets to begin with. So it wasn't a big explosion in the Fed's holdings of Treasury securities, but in its holdings of other assets that caused its balance sheet to go way up, mainly mortgage-backed securities, federal agency debt, holdings of commercial paper, and at the time, actually, the Fed took into partial receivership a lot of the assets that were originally owned by Bear Stearns, which failed or was purchased, I think, by Goldman or one of these other financial institutions at the time, as well as AIG, which was this giant insurance conglomerate. The Fed took on a lot of their assets, risky assets, on their balance sheet. So I bring this up because I want to raise a key point. The Fed can increase the monetary base by purchasing an asset of any kind. It doesn't just have to be Treasury securities, right? There used to be this argument that was sometimes circulating in politics that it would not be a good idea for the U.S. to completely pay off all of its debt. And why is that? Because if the Fed paid off all of its debt and there were no more outstanding treasury bonds in circulation, then the Fed would have no ammunition. They couldn't purchase anything to affect the money supply. Well, that's actually not true. The Fed can purchase alternative assets, right, in different situations. And when they do that, it expands bank reserves and therefore the money supply, in the process that we're going to talk about today. It doesn't actually matter what the Fed buys. As long as they buy an asset, they're going to expand the monetary base. Jameson, if the Fed somehow wrote you a check for your home or your car, that transaction would raise the money supply because the Fed would issue currency directly. Or alternatively, they would deposit funds into your checking account, which would increase the monetary base and increase the money supply. So it doesn't matter if the Fed is buying treasury securities or if the Fed is buying a fleet of automobiles or 1,000 computers. Anytime they purchase something, we're going to end up increasing the monetary base by injecting reserves into the banking system. Okay, let me move on then to the second major learning objective for this section of the course, and that is on this idea of a simple deposit multiplier. So we're now ready to examine more closely how the overall supply of money, so not just the monetary base, but the total money supply in the economy, can be increased or decreased through a process that's called multiple deposit expansion or multiple deposit contraction if the money supply is decreasing. In analyzing this deposit expansion process, what we're going to try to accomplish today is to derive a simple formula called the deposit multiplier, which is going to do something helpful for us. It's going to show us exactly how, holding a lot of other factors constant, if we were to change the amount of bank reserves in the banking system by some amount, that's going to translate into a particular change in the overall size of the money supply. So, for example, if the Fed were to increase bank reserves by $1, the money supply might go up by $5. In that case, the deposit multiplier is 5 in that simple example. What we're going to do today is derive the formula that allows us to show how a change in bank reserves and therefore a change in the monetary base translates into a bigger change in the total money supply. So remember that picture I showed you guys in the last class that had the monetary base times the money multiplier is equal to the money supply? We've talked at length about the monetary base. Now we want to start talking about the factors that influence the money multiplier. The starting point for that discussion is this thing called the simple deposit multiplier. Okay, so to illustrate how this is going to be a little bit different than what we've done in the last class and at the start of this class. So the questions that we've been interested in so far were how a central bank action, like a open market operation or a discount limit, change the monetary base. That is, they change the amount of bank reserves in the system. That's very much a static type question. What I want you guys to start thinking about now is the dynamics of that. How does that action spill over into the rest of the banking sector and therefore affect the total supply of money? Remember how we measure money. The cleanest way to think about money is with the M1 monetary aggregate. It's currency in circulation plus all of those checkable deposits that we hold. Banking behavior can affect the amount of checking deposits in the economy through this deposit multiplier process. And so instead of that static problem, we're going to think more dynamically now, how those central bank actions kind of permeate throughout the entire banking system. Okay. I think, again, instead of trying to talk about this in just purely abstract kind of theoretical terms, it's easiest to just work through kind of plug and chug an actual concrete example where the mathematics is really easy so that it's kind of intuitive for everybody, okay? So that's what I want to do. Let's start with a simple example here whereby the Fed decides to purchase $100,000 worth of U.S. Treasury bills from Bank of America. So it's very similar to one of the examples we talked about earlier. The Fed conducts an open market purchase of $100,000 worth of U.S. Treasury bills. The basic question I want you to think about for the remainder of class today is not necessarily how that affects the monetary base, we've already talked about that, but how it's going to have a larger impact on the total supply of money, where the total supply of money is not just currency, but importantly, critically for this problem, it's checking account balances at all of the banks throughout the banking system. Okay, so how are we going to analyze this? Well, we're going to do it just with brute force by looking at the balance sheets of all of the different banks that are affected by this transaction, okay? The first bank that's going to be affected is obviously the one that is doing business directly with the Fed. Here we have Bank of America selling $100,000 worth of Treasury bills to the Fed, all right? We've got Bank of America's T account here, its assets and its liabilities. You guys should be good enough at this by now to recognize what's going to happen to Bank of America's balance sheet, right? If it sells $100,000 worth of U.S. Treasury bills to the Fed, how does that transaction take place? Those securities, the ownership is transferred electronically to the Fed, right? But Bank of America has to be paid something. How is it going to be paid? Not just with a briefcase full of currency, but rather with new reserve balances, right? And so Bank of America's securities holdings are going to fall by 100,000, but their reserve balances will rise by 100,000. The Fed will instantly credit their reserve account by the value of those bonds, okay? So there's no net change in the asset position of Bank of America, which means there's no change in liabilities. All right. Now, to think about how this action, this open market purchase of bonds, of treasuries, is going to impact the larger money supply, what we want to think about is how it affects required versus excess reserves in the banking system, and then what incentive banks have after that to offload those excess reserves to other investors. All right, so I'm going to, again, make a bunch of assumptions here to try to make the math as simple and straightforward as possible. Okay, first off, let's assume that the required reserve ratio in this pretend little economy we're dealing with here is 10%, okay? So 10 cents off of every dollar that is deposited into a bank has to be held in reserves. The other 90 cents are loaned out to other investors. Okay, I want you guys to ask yourself this first. What happens to Bank of America's excess versus required reserves as a result of this open market operation? How much have excess versus required reserves changed by? And remember how we define, what are required reserves? Now be careful about this. What are required reserves? Now, this is the fraction of a bank's checkable deposits, that is its liabilities, that banks must hold in reserve. If the bank simply sells some of its securities to the Fed, has anything happened to its checkable deposits? No. So even though the Bank of America has now $100,000 worth of bank reserves, all of them are excess reserves because there's been no change in checkable deposits at Bank of America. So excess reserves here have gone up actually by $100,000. Required reserves haven't changed at all. And I kind of briefly described that, by the way, in that little box with red lettering on the right-hand side of the slides there. Okay? Now, ask yourself, if you are the CEO or the CFO of Bank of America, what do you have an incentive to do if your excess reserves have now gone up by $100,000? Who was that? Speak up. Levi, go ahead. Loan it out, yeah, right? Now, we live in a world where, in fact, banks do get some interest on their excess reserves. It's like 0.25%. But presumably, banks can make more by loaning them out to another investor. There's some risk attached with that. So banks may be reluctant to do that. But there's at least an incentive here to want to loan out those excess reserves. All right? Let's assume here that Bank of America goes ahead and lends out all of its available excess reserves. So prior to this transaction, they had no excess reserves. Now they have $100,000 worth of excess reserves. They find a suitable investor and make a $100,000 loan. How does that show up on Bank of America's balance sheet? When you take out a loan from the bank, does the bank, again, just give you a sack of cash? No, the way that works in practice is the bank simply credits your account in the amount of the loan, right? So the second that Bank of America lends out that $100,000, what they do is they credit the checking account balance of whatever investor is taking out the loan. And so that's a $100,000 liability now for Bank of America, which means there needs to be a $100,000 asset. Well, what is the asset? The bank has created a new loan, right? So balance sheets balance in this case. All right. Now let me stop there for just a minute. What has now happened to the money supply? Not the monetary base, but the actual money supply as a result of Bank of America's decision simply to make a loan to an investor. The money supply is currency plus demand deposits or checking account deposits. As soon as Bank of America has loaned this $100,000 to an investor, that now becomes an asset that the investor can use to spend on goods and services. So they have instantly increased the actual supply of money in the economy by $100,000. So when the Fed buys the bonds from Bank of America, they're expanding the monetary base by 100,000 as bank reserves go up by 100,000. But that doesn't translate into an increase in the money supply until somebody's checking account balance goes up by the same amount. So the bank's action here to procure a loan for an investor increases the money supply by $100,000. Okay, now let's continue on this example. So Jameson, let's suppose that you are the investor here and you've taken out this loan. I'm Bank of America. I've stuck $100,000 into your checking account, okay? You find a suitable investment opportunity and you're gonna purchase investment products from, what's your name again? Derek. Okay, so he's the seller in your transaction, all right? Once, and let's say you pay for those goods by writing a check, okay? Once that check clears the banking system, how is that going to show up on Bank of America's balance sheet? So now you're spending the proceeds of that loan to a seller, right? How does that show up on Bank of America's balance sheet? Well, remember how the check clearing process works. The Federal Reserve is going to debit the reserve account of your bank, which is Bank of America, by $100,000 and credit the reserve account of Derek's bank, which in our example is going to be PNC Bank. So once the check clears, what happens is that $100,000 liability, Bank of America now no longer holds because you've spent that money. So that's not a liability for Bank of America anymore. But they pay for that by drawing down their reserve balances with the Fed, by the Fed debiting their reserve account. And so there's a $100,000 reduction in liabilities matched by the same reduction in assets. But notice here that nothing has happened to loans. Bank of America, you still have this loan obligation with me. And so that's considered an asset for Bank of America. Okay, let me consider now the second thing, because what we want to do here is think about how these transactions have a multiplying effect on the total money supply. So we have to think about how these actions have ripple effects through the entire banking system. All right, so Derek, you have deposited this check in your bank, which is PNC. Once that check clears, how does PNC's T account appear? PNC now has a $100,000 liability in the form of a new checking account deposit. And that money, remember, the Fed credits the reserve account of PNC and debits the reserve account of Bank of America. So there has been a $100,000 increase in assets and liability on PNC's balance sheet. Again, the money supply here has gone up by 100,000. Initially, it was 100,000 more in checkable deposits at Bank of America. Those fall, but they're matched by $100,000 of new checkable deposits at PNC. So the money supply has still only changed by 100,000 at this point in the example. Okay, so effectively, what has happened here is that Bank of America originally started with 100,000 worth of low interest securities. And through the process of loan creation, they've transformed those securities into $100,000 worth of higher interest loans. And that expands the money supply because it creates additional deposits within the banking system. Okay. Again, I want you guys to think about these problems a little bit more dynamically. So this is obviously not the end of what happens with regard to how the Fed's open market operation affects the money supply. What do you think is going to happen at PNC Bank once they receive this $100,000 increase in their bank reserves? The way to think about this is to ask yourself, what happens to excess reserves versus required reserves? Here it's a little different than what happened at Bank of America, right? PNC was the recipient of new checkable deposits from this purchase. And so the reserves have gone up by $100,000, but what's the effect on excess versus required reserves? If we assume that the required reserve ratio is 10% everywhere in this economy, just to make the argument as simple as possible, then that means required reserves will have gone up by $10,000. Excess reserves will have gone up by $90,000, right? And so what do the good folks at PNC then have an incentive to do if they see an increase in excess reserves of $90,000? They don't just want to hold that with their reserve account with the Fed, but rather they'd like to lend it out to investors and potentially earn more interest, okay? And so what do? PNC now finds, Levi, let's say you are a second investor and you decide to take out a loan from PNC in the amount of $90,000. That's the maximum that PNC can loan out and still meet their reserve requirements, okay? Now again, how does PNC provide this loan? Pay attention here. They're going to deposit $90,000 into the checking account that Levi holds with PNC Bank. So there is a second loan that has been issued in this economy. So what has been the total effect now on the money supply? Gone up by 100,000 plus an additional 90,000, right? There's $190,000 worth of new checkable deposits. This is the sense in which banks, quote, create money. They don't literally print the dollars, but what they do through the process of loans and then deposits and then more loans is expand the money supply through deposit expansion, loan deposit expansion. Okay? Learn some more names. What's your name in the back row there? Say again. Daniel? I can't remember. James, okay. James, let's say that Levi here has taken out this loan from PNC Bank for $90,000, and he wants to purchase investment products from you. And he pays for those products by writing you a check for $90,000. That check clears the banking system. And so what then happens to PNC's balance sheet? Checkable deposits will decline by $90,000, and PNC will pay for them by drawing down their reserve balances by $90,000. Okay? In other words, the Fed is debiting the reserve account of PNC, but they're simultaneously crediting the reserve account of your bank. You are the second seller in this twisted train of logic here. Let's suppose, James, you said, okay, sorry. Let's suppose that your bank is Suntrust, a third bank in our example today. Once the check clears, how does that show up in Suntrust's balance sheet? Well, just like the previous example, checkable deposits at Suntrust will increase by $90,000. That's the size of the check you receive. And that immediately is going to increase reserve balances at Suntrust by $90,000. Suntrust is no different than the rest of the banks here. They have a reserve requirement of 10%. So, James, when you deposit your $90,000 check, what happens to reserve requirements? What happens to, required reserves versus excess reserves at Suntrust? If they have a required reserve ratio of 10%. Required reserves will only go up by $9,000, which means that the bank's excess reserves go up by $81,000. Suntrust is going to have an incentive here, again, just like PNC, to loan out as much of their excess reserves as possible. And so they're going to identify a third investor in this example to make a loan to, and they're going to credit the checking account that that investor has with Suntrust Bank in the amount of $81,000, bringing total checkable deposits at Suntrust to $171,000. So the third transaction that we've talked about in this example once again expands the supply of money in the economy by an additional $81,000 because it's increased checkable deposits in the economy by exactly $81,000. Again, if that loan that Suntrust makes, the funds get spent and redeposited back into the banking system, then what's going to happen at Suntrust? The checkable deposits will decline by $81,000, and reserve balances will go back down to just the required reserves, just like they did in the previous example. Okay. And so up to this point then, how much have checkable deposits gone up by in the banking system? Well, there was a $100,000 deposit at PNC Bank, plus the $90,000 increase in checkable deposits at Suntrust Bank. Once the proceeds of that third loan in this never-ending example get deposited back into the banking system, what's going to happen? the total amount of checkable deposits in the banking system will rise by another $81,000, increasing the total supply of money then by, what is that, $271,000, right? $100,000 at PNC, $90,000 in additional checking at Suntrust, and then $81,000 of additional checking at whatever the fourth bank in this example. So what do we have here? We have multiple deposit expansion, right? An increase in bank reserves at Bank of America created by the Fed's purchases of Treasury securities sets in motion multiple rounds of loan creation and deposit creation. Those two things work in tandem to expand the total money supply. In this case, up to $271,000. I think I saw a hand shoot up in the back, but I might have forgotten. Does somebody have a question? No? Okay. That's what economists mean by multiple deposit creation. It's this critical part of the money supply process, whereby an increase in bank reserves that is initiated by the Fed sets in motion this series of new bank loans and new deposits, which expand the total money supply. That's why we call it the money multiplier process, right? Banks receive checkable deposits. They hold some of it in reserve, fractional reserve banking. They loan out the rest to investors. Those funds get purchased or used in the economy and redeposited into the banking system. Some of it gets held in reserves, and even more goes out the door in the form of a new loan. And that process repeats itself, and every time a new loan is made and a new checkable deposit is created, the money supply continues to expand. That's what multiple deposit creation is, and it's the critical way that the banking system influences the money supply, and is why the Fed can't perfectly control the money supply, because the Fed can't predict exactly how banks are going to behave with regard to their excess reserves and required reserves. Okay, now let me ask you guys this question. Do you think that the process of multiple deposit creation here is going to simply go on forever? We could go on with tedious detail around the room and do an example where loans are made to a fourth bank and then deposited into a fifth bank and then deposited into a sixth bank, and so on and so on and so forth, right? But the pattern is still the same everywhere. But the logic would tell us that every time we do this, the money supply is expanding. So does that mean that an increase in bank reserves by the Fed is going to ultimately result in an infinite amount of money in the economy? Or does this process of multiple deposit expansion eventually kind of die out? Well, to help think about this question, I've created this little table in the slides that shows 3 columns of information here. It's the increase in deposits at each of the banks in our example. It's the increase in loans at each of these banks, as well as the increase in their reserves. So the first line has what? There was a $100 deposit at PNC. PNC loaned out 90,000 of it and kept 10,000 as required reserves. That 90,000 gets eventually deposited in Suntrust Bank, where Suntrust keeps 9,000 of it in reserves and loans out 81,000. That 81,000 eventually got deposited into a third bank, where that third bank kept 8,100 in reserves and loaned out 90%, or 72,900. Now, up to that point, which is where we stopped, what did we see happen? The total increase in deposits was $271,000. That's how much the money supply expanded by. The total increase in loans was $243,900, and the total increase in reserves was $27,100. If we did this for another round, and the $72,900 loan at the third bank was deposited into a fourth bank, look how it changes the totals. Now there is $343,900 in total deposits and $34,390 in total reserves. How long does this game play out? Well, if we deposit into a fifth bank, etc., what I'm telling you here is that eventually what's going to happen in this economy is that the total amount of deposits that is going to be created by this initial injection of $100,000 in reserves at Bank of America will be $1 million worth of new checkable deposits. And the total amount of reserves in the banking system is going to increase by $100,000. So this is a critical idea here. Multiple deposit expansion is going to continue in the economy, according to this model, until what happens? Until every dollar of the original increase in the monetary base gets absorbed into the banking system in the form of required reserves in this example. So there's the multiple deposit expansion is going to have enough fuel to keep going until every dollar of that initial increase in bank reserves gets absorbed into the banking system in the form of reserves throughout the entire banking system, not just at Bank of America. Once that process, once all of those dollars are in the banking system in the form of reserves, no more new deposits and loans can be created from that original injection. The simple deposit multiplier is just the ratio of the amount of new deposits created by the banking system divided by the amount of new reserves. So in this super easy example, it's just $1 million worth of new checking account balances economy-wide divided by $100,000 in total reserves. And so what is the simple deposit multiplier in this example? It's equal to 10. So how do we interpret that? If the Fed increases bank reserves by just $1, by purchasing $1 worth of treasury bills in the open market, the simple deposit multiplier tells us that the amount of checkable deposits should expand economy-wide or system-wide by $10. A $1 increase in bank reserves leads to a $10 increase in the money supply that is in checkable deposits. That's what the simple deposit multiplier is. Now, how do we know for certain that this initial increase in bank reserves of $100,000 will ultimately lead to $1 million worth of new checkable deposits? So we did this little numerical example, and we went around the room and did 3 or 4 steps of the process. And then I showed you in this table that it ultimately sums to $1 million worth of new deposits. But you should not just take my word for it. In fact, we can prove that it should sum to $1 million in this case. And in doing that proof, we will derive the actual formula for the simple deposit multiplier that you can apply to any problem. Okay? I promise you, the proof is not really that difficult. It just requires you guys to remember a couple of lines of algebra. And once we go through it, you can just apply the formula, and it's pretty straightforward. Okay? In this example, what was the total change in deposits? So this delta capital D variable, that refers to the total change in checkable deposits system-wide. Well, what was that equal to? It was 100,000 in deposits at PNC plus 90,000 in deposits at Suntrust. So that's 0.9 times 100,000 plus 81,000 in deposits at a third bank, which is the same as 0.9 squared times 100,000 plus dot, dot, dot. It's an infinite sum, okay? Here's where the algebra comes into play. Let's factor out of this infinite sum $100,000. What are we going to be left with? A 1 plus a 0.9 plus a 0.9 squared plus a 0.9 cubed on out to infinity. That's what's called a geometric sum. You may remember that from your algebra classes. Okay, let me rearrange this a little bit. Everybody follow me so far? Right? Let me do the following. I'm going to separate the first term in this infinite sum from the last set of terms. So that's equal to $100,000 plus, let's see, 100,000 times quantity, 0.9 plus 0.9 squared plus blah, 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 blah. Now imagine from that second term, we factor out a 0.9. What are we going to be left with? 0.9 times 100,000 times quantity 1 plus 0.9 plus 0.9 squared plus 0.9 cubed, and on and on and on. Now that may seem like a silly thing to do, but what do you notice this term is equal to? That's just the same as the first line in that argument, right? 100,000 times this infinite sum here is just the total change in deposits from the first line. So the change in deposits is 100,000 plus 0.9 times the change in deposits. If you rearrange that equation, you get 1 minus 0.9 times the change in deposits is 100,000. The change in deposits is 1 divided by 0.1 times 100,000, or $1 million. The simple deposit multiplier is just this part right here. It's 1 divided by 0.1. And what is it equal to in this problem? Notice that it's just the inverse of the required reserve ratio. In this problem, we assumed all banks simply held 10% in the form of required reserves. 0.1. If you put that on its head, so 1 divided by the required reserve ratio, then tells us what the simple deposit multiplier is. So a $1 change in bank reserves created by the Fed is going to create new checkable deposits in the entire economy by the deposit multiplier times the change in reserves. And in our example, that was 10 times the change in reserves. $100,000 of reserves ultimately leads to $1 million worth of new checkable deposits. Any questions about that? So I'm not going to make, you don't have to memorize the steps of that algebra. I showed it to you to hopefully you get kind of an intuitive sense about where the deposit formula comes from. You should be able to apply this deposit multiplier in simple problems. If I tell you what the reserve ratio is, and I give you enough information so that you can deduce what the change in bank reserves is, you should be able to put those two things together and tell me how much deposits in the economy have changed by. Can the Fed reduce the volume of checkable deposits in the bank by lowering bank reserves? How does that work? In our example today, the Fed bought Treasury securities from a bank. Well, what if the Fed sold Treasury securities to a bank? Then bank reserves would have fallen by $100,000. And by the same logic, what would that have set in motion? Not rounds of multiple deposit expansion, but multiple deposit contraction. So the money supply can fall through the money multiplier process in the same way that it rises. What happens, do you think, to the money multiplier, the simple deposit multiplier, if the reserve ratio were to get bigger, let's say? So now banks are holding 20% in reserve instead of 10%. What happens to the simple deposit multiplier in that case? It goes down. And think about it, that makes intuitive sense. If banks elect to hold more in excess reserve and loan out less to investors, that means fewer dollars are getting redeposited into the banking system. And so the increases in the money supply are going to be smaller. So the higher our reserve requirements, the smaller our is the deposit multiplier. If banks elect to hold less reserves, the simple deposit multiplier should expand. Hopefully, guys, this should give you a little bit of foreshadowing about why the money supply hasn't expanded by as much as we've seen the monetary base go up by in recent years. And the primary reason is because banks have elected to hold a ton of their reserves in the form of excess reserves. And the more excess reserves they hold, the less they're lending out to other investors, and the less deposit creation we get. And so the money supply doesn't go up as much as this formula would suggest that it otherwise would. Okay, let me do a quick example of a problem that applies what we have gone over today. So let me show you, actually, the problem I want you guys to work is this won't take very long, but we'll do it together. You can find it on Blackboard. There are these in-class problems. And let's try number 5. For you folks that are participating remotely, this is the question. It's number 5 here. If the Fed purchases $1 million worth of security and the required reserve ratio is 8%, how much will deposits in the entire banking system change by? And in doing this, you can assume that all banks maintain 0 excess reserves, and also that the public's holding the currency don't change. So in this problem we worked through today, we assume that each of these investors simply redeposits every bit of that money back into their checking account instead of holding any of it as currency. If we continue on those assumptions, how much does a $1 million purchase by the Fed of securities increase the total money supply in checkable deposits in the economy by? Why don't you work on that for just a minute, and then we will go over the answer together. For you folks, again, that are participating remotely, I'm going to flip over to the document camera now. So just bear with me for 1 sec. Okay. I don't have a whiteboard in here, so I'm gonna have to do, when I do these kind of exercises, I'm gonna have to do them on the document camera, which I'm a little clumsy with, so I apologize ahead of time. Anybody have any idea ideas about how to do this one. So the Fed purchases $1 million worth of securities. The required reserve ratio is 8%. How much should check deposits go up by? This is just a simple application of the simple deposit formula. Right, so the change in deposits is equal to 1 divided by the required reserve ratio times the change in bank reserves. Now in this question, it tells you that the required reserve ratio is 8%, right? So the simple deposit multiplier is just 1 divided by 0.08. How much is the change in reserves? Well, the Fed initially purchases $1 million worth of securities. That's an open market purchase, which immediately injects $1 million worth of bank reserves into the banking system. What's 1 over 0.08? 12 and a half, is that right? 12.5 times 1 million. And that gives us $12.5 million. So with a reserve ratio of 8% instead of the 10% like we saw in class, the simple deposit multiplier is bigger. It's 12 and a half instead of 10. And so $1 million purchase by the Fed of treasury bonds should expand checkable deposits in the economy by 12.5 million. Now I'm going to stop there, and let me just warn you one thing. This is just the simple deposit multiplier. We call it the simple deposit multiplier for a reason. It's just supposed to provide you guys intuition about how the money supply process works. I'm not suggesting that if the Fed were to buy $1 million worth of bonds, that the money supply would go up by 12.5 million. That's way more than what the effect would be. And what we're going to do in class on Wednesday is talk about a more realistic money multiplier that takes into account the currency decision that the private sector makes, as well as the excess versus required reserve decision that banks make. When you factor those kinds of things into the calculus here, you're going to find that the money multiplier is much smaller. We're going to work through one of those examples together, and then I'm going to show you guys some actual data on how the money multiplier has changed quite dramatically in the US over time. The implication is that this model of the money supply process is really not a useful model for predicting how open market operations will ultimately change the money supply. It's not a good forecasting model. What it does is it helps explain the money supply process through deposit and loan creation. It's not a very good predictor of what would happen in the real world because lots of things are happening simultaneously, right? And banks and the private sector oftentimes change their behavior when the economic landscape changes, which causes the money multiplier to be extremely unpredictable. And when we apply the idea to actual US data, I think you guys will see that. There was a big drop in the money multiplier during the great financial crisis. And then we'll be finished with this section. And so next Monday, be prepared for your first lab. So if you guys come to class, I'll provide you with the assignment here. And for those that are participating remotely, you'll just need to download the lab to your computer and then submit it to me electronically. The hope is that you'll be able to finish that lab assignment during the class period. Yes? Is there? Oh, it's Labor Day, isn't it? Okay, so the lab will be on Wednesday. You're right. Thank you. Okay, any other questions? All right, that is all I have today. I apologize for you guys that were zooming in for the mic failure. I'll try to not let that happen next time.